Welcome back to the Real Estate Investing Fundamentals Masterclass. We have so far covered mindset, deal flow, estimating repairs, and evaluating deals. And today we're going to be talking about money. We're going to be talking about financing. This is really the number one excuse that people have for us not investing in real estate. And they just say, I don't have enough money, or I don't have the money to invest in real estate. And the truth is that you'll never start doing deals until you make up your mind and become committed to finding great deals and providing value to the marketplace. And when you do that, and this is something we talked about in the mindset session of this masterclass, and when you do that, funding your deals is really easy. The ability to raise capital is the number one skill set of an entrepreneur. It's a quote by Robert Kiyosaki. This is really, it's critical to your long-term success in real estate, but also just in business. And that's what we're going to be covering today. That's what you're going to learn today. All right. There's good debt and there's bad debt. Who's heard that before? I know there's a lot of people out there that believe that all debt is bad debt. There's some gurus out there that teach that all debt is bad debt. Doesn't matter what it is. It's bad. Don't have it. But there's really, there's a difference. And if you've never heard this concept of good debt versus bad debt, just kind of hang with me for a second. So what is good debt? Good debt is used to buy assets, or good debt is used to buy assets that financially benefit you. And this would include things like a mortgage to buy a rental property, or maybe a loan to buy a house that you're going to flip. That would be considered good debt because a rental property financially benefits you. A house flip, whenever you complete the rehab project and sell it, it financially benefits you. Those are examples of good debt. Now, the best assets, in my opinion, to buy with good debt would be income producing assets, like the rental property example, because when you're taking out that debt and using it to buy an asset that is producing income, and especially income that exceeds whatever the monthly payments are on the debt, that gives you cash flow. And essentially what you have is an asset that's paying for itself. In the case of a rental property, you have a tenant that's paying your mortgage off for you. So if you play that game long enough, eventually you have an asset that is debt free, and you still own the asset and you still own the cash flow. It's a wonderful game to play if you play it right. But bad debt is still bad debt. There's no getting around. There is still debt that is bad. And examples of bad debt would be anything that does not financially benefit you. And this is all the stuff that probably makes sense. Consumable debt, credit card, like if you have a carrying balance on your credit card for consumable products, vacations, if you're buying that hot rod sports car and you're getting a loan on that, those are, I mean, if there's not a direct tie to how that financially benefits you, then it's bad debt, and you really shouldn't have any bad debt. There's no reason for it. It's not going to financially benefit you. Actually, it's going to harm you every single month. Now, even with good debt, you still have to leverage wisely, because good debt, if it's not used wisely, it can turn into bad debt. You don't want that. So debt is a tool and it must be used wisely. You want to use good debt to buy assets where you're gaining equity. So in the case of real estate, we're buying homes at a discount. So we're getting equity when we buy the property, or we're forcing equity because we're doing work to the property, or we're increasing the income that the property produces for a rental property. It produces cash flow. Speaking of rental properties, sustainability. So it's not in some unsustainable type of asset. Now, real estate, it's pretty stable. There's a reason why the stock market can crash overnight. Real estate typically doesn't do that. It takes a long time if there is a downward turn in the real estate market, it takes a while for that to play out. It takes a while for things to go up as well, with some odd cases that you could point out to that may be contrary to that. But by and large, real estate is fairly stable. And then multiple exit strategies. So it's really good, like using good debt to buy assets that produce cash flow or financially benefit you, but having multiple exit strategies on that asset just further mitigates risk. And this is just another thing that you should do. And we've talked about this before on how you can use good debt and use it wisely. And if you do that, it can really make you a fortune. All right. So there are, I know it says 5 options here. There's 6 options. It's because I added seller's financing at the bottom. I should update that. So there's 6 ways that you can fund every single deal that you do. And there's more nuances to it, but we're going to be covering these. You have cash, bank financing, partners, like JV partners, hard money lenders, private money lenders, and then seller's financing. This is the 6th or bonus way that you could finance deals. We're going to break each one of these down and kind of look at the various pros and cons. So cash. You're using cash. Why would you want to use cash? Well, one, it's really fast because it's cash. And if you have cash in the bank, there's no underwriting that needs to be, you don't have to fill out paperwork and have it go to some underwriting committee that you'll never talk to and have them say, hey, you're approved or not. Like it's pretty quick. As far as rates, costs, term, like that's all, you don't have to worry about any of that. You're saving money on interest because you're not paying any interest on a loan because you don't have a loan. You use cash, right? There's no fees. You didn't have any origination or points. You didn't have any application fees or anything like that. So that's all money that you're saving. The leverage is none because you're not using any leverage, you're using cash. And the personal risk, though, is high. And that's because all of your cash is in the deal. So if anything happens to the deal, you are 100% from a cash perspective on the hook. Like it's your money that's at risk. Now, you don't have any monthly payment, so your leverage is, you don't have to worry about that. But on the saving money part, and this is really where, some people, especially if you have cash, they'll really think about this as, hey, I'm just saving money. I don't want to have to pay interest every month. I don't want to pay loan or origination and all this stuff. But how much is your money really worth? Like, what's the opportunity cost for your money? And as you'll see, as we talk further today, you probably have much higher opportunity cost for your money than putting it into your own deal. Because when you really play it out, especially if you learn, we're going to talk a lot about private money lending, like you could probably make 10, 14%, maybe more if you loaned it out to other investors. But when it really comes down to is if you put all your money down on a deal, how many deals can you do before you run out of cash? Because, you're not the US government. You can't just go print money anytime you need more. Like we can't do that. So if you are using the cash model where, hey, I'm just going to save up money, buy cash, buy properties with cash, how many deals can you do before you run out of money? You're very limited in the number of deals you can do. But that limitation, you don't really have that as much when you learn how to finance properties and use leverage wisely. Which another one of those ways you can finance properties is through bank financing. Now, bank financing, it's slower. There's a lot more underwriting, paperwork involved. But the benefit, if you want to wade through all the red tape, is you're going to get some of the best rates available on the market. Generally, it's prime plus a point or two. The costs of these loans, as far as origination points, fairly low. Some you could maybe even get no points, maybe a point. Very rarely are you going to get bank financing where you're going to pay more than a point. It's possible, especially if you're doing like rate buy downs or anything like that. Now, the term, 15 to 30 years. If you're using local bank financing or more regional state bank financing, a lot of them, especially for investment properties, you're going to see the term being more 15, 20 years. But if you're going with a conventional loan, Fannie Mae, Freddie Mac, those you can go up to 30 years, and you're going to get the best rates. Those will have even more red tape, and then as you grow, eventually you'll have to go with local banks. These are good. A bank is a good resource for rental properties, long-term holds, construction loans, especially refinancing properties into your long-term hold, like for rental property. And then lines of credit. Now, lines of credit, whether secured or unsecured, banks tend to be really good for this type of loan. Your leverage, though, it's typically going to be capped at 80% loan to cost. 80% loan to cost, meaning in the hypothetical situation that you get a really, really good deal, it's worth $300,000, but you get this deal like just a rare opportunity where you get this home run deal for $100,000. It's worth 300, you get it for 100. And say it only needs 20 grand in repairs because it's just paint and carpet. The bank doesn't care that it's worth 300. I mean, they do care, but the loan is going to be based off your 100,000, and it'll be based on loan to cost. And the cost to you is 100,000. You're paying $100,000 for it, and they're going to give you, in this case, in this example, $80,000. That'd be the max loan to cost. That'd be the max loan amount that you'd be able to get. So you're going to end up having to put a lot more money down as a down payment if you're using bank financing to acquire the asset. Now, refinancing is different. They do approach it differently. We're just talking about acquisition today. Then partners. I throw this in there because a partner, it can be an excellent strategy when buying a property. You can also call this like a joint venture. Really, everything varies here because it really just depends on what you both agree on. And really, like, you want to bring on a partner. Like, if you're going to bring on a partner, you really want it to be someone who has something that you lack, whether it's a skill set, it could be financing, it could be credit, it could just be that they're really good at project management, or they're local on the ground and you're maybe further away or in a different city or different market than the property. This is where partnerships can be really helpful, but they are like temporary marriages. They're marriages, but temporary, because ahead of time, at some point, one day you will both go your separate ways. You may be friends. Hopefully you should still be friends. But as far as your professional relationship, that will be terminated at some point. And knowing that to be true, it needs to be crystal clear on what the expectations are for both of you, and how, when that day comes where you need to go your separate ways, how that happens, how everything is allocated. It should be so clear that you could hand that to someone else, the outline of that, they'd be able to really easily understand how that would work out. So, and also, just kind of my personal opinion, partnering with a contractor, and I say this because I've seen this happen a couple times. If you partner with a contractor, which is not necessarily a bad thing, but if you partner with a contractor who's going to provide free labor on the rehab, that it's a risky deal to me. Ultimately, I mean, if you're getting competing bids and you can outline exactly what labor costs would be, maybe that could work. But really, I think it's better if you just have that written into the finances of what the deal is going to cost, and just split your profit allocation and make that adjustment accordingly. Because if you're having a contractor partner who's providing free labor, whatever that is, what I've seen happen is people will do that, and then what ends up happening is because costs cost what they cost. Like, labor has a cost, materials have a cost, but when it's vague because they're just providing free labor, you end up having a partner that they win no matter what. The contractor wins no matter what, because either the deal goes well and then they profit, or the deal doesn't go well, but their guys get paid because they're having to continue to siphon money out of the project, and you're left stuck with it, because if there's an impasse at some point and there's no more money, they walk away and you're stuck with a deal. I've seen it happen. So I think if you're going to partner with a contractor, it's just easier to figure out what the costs are, get competing bids, so you know that your contractor's in line and what they can do, and then just use that as far as the whole equation. But ultimately, make sure your partner is providing some sort of value or skill that you lack. Now, seller's financing. Seller's financing is great because it's fast. There's no underwriting really. As far as rates, terms, costs, and all that, it's really what you negotiate. Typically, terms are fairly short. Rates are usually pretty low. And there's pretty much no cost to it as far as origination fees. Your leverage is going to vary too. And I think this works best whenever it's a free and clear property. But even if they have an underlying loan on it, they could maybe hold back a portion as a second loan. And then there's another variation of this, which isn't direct seller's financing, but it's called subject to. This is more indirect seller's financing because they already have a loan in place. And if that loan, that mortgage is, 2.5%, 3%, maybe 4%, it may make sense to just take over the payments for that. It's not officially owner's financing at that point or seller's financing, but it's kind of an indirect way where you're just taking over what they already have financed. And then now you're going to have to figure out whatever their equity portion is. How are they going to be compensated? Are you going to bring cash to the table? Or are they going to hold that back as a second? Or are you going to get some other lender in place as a second? Then there's hard money. Now, hard money it's very fast. Underwriting is low to moderate. Kind of depends on your relationship with a hard money lender, and local hard money lenders will typically be faster and more streamlined for you in your market and your property than maybe a national one. You may pay a little bit more, but they're typically going to know your market better, be able to move faster and have less underwriting for you. But there is some level of underwriting still for hard money. The great thing is they're not really interested so much in you. I mean, they are going to kind of look to see, if you had a bankruptcy last month, that's going to concern them, but they're not as concerned about what your credit score is or anything like that. They're very concerned on the property. What is the property? Their rates are going to be higher, 10 to 14%. And if you've never looked into hard money or heard of hard money before, or seen 10 to 14% as an interest rate, that may just sound scary to you. Like, who on earth would pay 10 to 14% interest rate on a loan? And to answer the question, I would. And I would do it again. I've done it before, and experienced real estate investors everywhere would absolutely do it if they needed to do it to get the deal done. Because you're not, if you really understand this, you're not in a hard money loan long term. This is a short-term deal, 6, maybe 12 months. As far as the loan term, and typically, at least my average, was actually in the deal much shorter than that, more like 3 to 4 months. So especially if you're talking about rental properties, we're going to hold them for a long period of time. The rates and the points, which can be 3 to 5 points, that is it ends up amortizing to be a very small amount of the overall project and what you're going to make on the deal. And as far as a house flip, where it's a short-term deal, you just want to make sure that these costs are going into your profit model, your business model, to make sure that you're making the margins that you need to be making. So as long as that's factored in, it doesn't necessarily matter that you're paying the 10 to 14%, which, in the short time period isn't that much. Now, the real costs are going to be the points, 3 to 5 points, because you're going to pay that up front, and that is a lot. But when you're factoring all that into the deal, for long-term like rentals, it's not really that much. For short-term flips, you just want to make sure that this is all calculated into your cost structure, into your deal analysis, to make sure that makes sense if you're getting that kind of loan and you're still able to hit your margins. Now, your leverage here, this is really one of the best things about hard money lenders. Like I was talking about with banks, they're going to loan to cost. Hard money lenders will loan to value, much different. So we talked about with the bank example, I said $300,000 house, like you get this home run deal where you get it for $100,000. Extreme example. I know it's probably not likely, but definitely could happen. So just say you got that house, $100,000, needs $20,000 in work. Well, the bank is going to give you $100,000. They're going to base the loan off the $100,000. That's your contract price. So they're going to give you $80,000. Hard money lender won't do that though. They're going to look at that $300,000 because they know that's what it's worth once you put in the work. So you do your paint and carpet and your $20,000, and now it should be worth a market value of $300,000. So they're going to use that number to base the loan off of. And from a 75% loan to value, they would be willing to give you a loan of up to $225,000. Now your contract price is $100,000. You need an extra $20,000 for repairs, so you're all in for $120,000 plus some closing costs. So this is a no money down deal, because in this situation, Many hard lenders, not all of them, some of them still want some financial skin in the game, but the hard money lenders that I've worked with, every single one actually, 100% no money down deal, 100%. That's how you get no money down deals. Ultimately, you're just getting your overall purchase price, your overall project cost, your all-in price below that 70%, 75% loan to value. As long as you can do that, then hard money companies, a lot of them will allow you to go in and finance 100% of your project. Now, as far as the repairs go, even though they're financing it, they're going to hold that back in a repair escrow. And then you'll front that, whether through a line of credit, your own personal cash, or a credit card or whatever, and then they'll reimburse you in draws. That's how that works. But your overall personal risk is low. A lot of them don't have personal guarantees. If you screw it up, like they're just going to foreclose on it, and they'll end up taking it and flipping it themselves. But the great thing about hard money lenders, and why, if you're new in this business, like I highly recommend work with a hard money lender in your first couple of deals, because they have especially local ones. They have local expertise. A lot of them are very active investors themselves. So they know what's going on in the market. They've got a good pulse on it. They know things that, like, they know to look out for certain things that you may not know yet. And they're going to be a really good resource for referrals, for contractor and vendor referrals, and especially valuation. Like, they're not going to loan you money on a bad deal. Or basically how they protect themselves is saying, hey, I think you're paying too much for this. If you still want to do the deal, you're going to have to come to the money with table, bring money to closing. But if you get a good deal, like, hard money lenders can be your best friend. Highly recommend them. Now, if you play this game long enough, what you really want is private money. Private money is where it's at, because private money is fast. There's low to almost no underwriting. I don't think there's been a single out of 200 something flips, which 95% of those were with private money. I don't think a single one has ran my credit score. I've offered it on some. I just don't think any of them have. I could be wrong. It's been a while, but pretty much no underwriting. They just really want to like and trust you, and that's number one, because they're really, even though they want to make money, preservation of capital is really priority to them. They want to make sure that, hey, one, you're going to pay it back, and then two, you're going to get them a good return. Which the rates for private money, it can vary, but 8 to 12% is common. I've paid more, I've paid less. But that's pretty common for private money. As far as our loan, points or origination, 0 points. Usually you'll pay a point or two at the most. Very rarely have I paid more than 2 points for private money, but I have before. Terms vary. Typically it's short term, because this is their own money, their own savings account or self-directed IRA that they're investing. So it's usually kind of short term for private money lenders, 6 months, 12 months. I have had private money lenders loan for longer terms, the 1, 3, 5 years. Not many of them want to go that far out, because this is their personal cash and they may need access to it, and they want to generally keep things fairly short. And then leverage. Their leverage is typically similar to a hard money lender. So up to 75% loan to value. And then your personal risk is very low. Now, I really want to caveat, I have personal risk here low, and it's really low in all of these except for cash, because it's your money, right? But if you're using private money lenders, that personal risk low, you should just throw that out the window, because really it should be personal risk high, because you're willing to sell everything that you have to make sure your private money lenders are made whole. In the event of a worst case disaster, where it's like you lose money, you're willing to sell your car or whatever to make sure your private money lender is made whole. Like that's the mentality you need to have. And if you treat your private money lenders that valuably, guarantee you they can make you a fortune, and they'll be eager and actually pound down your door if your deals slow down, because they know, like, and trust you, and you're making them a lot of money, and they know that you're a good custodian, or basically you're someone that's going to treat their money like yours. That's what you want to do. But wait, there's more. So a lot of the benefit comes with working with a private money lender, other than the ease and slightly cheaper than hard money. No credit checks, no down payments, very flexible terms. It's really just kind of depends on what their needs are and what you negotiate. Deferred payments, that was a huge one for me, deferred payments, because especially house flipping. If you're flipping houses and you got multiple projects at the same time, that whole business model is a lot of money going out of your bank into contractors and everyone else's pocket, not yours, until you sell the house, which can be 90, 120, 180 days away. So a lot of money going out, and then you get one big payday at the very end. And if I can stop at least one form of that money going out, in this case, hard money, monthly payments, I'm definitely going to do that. So nearly all of the terms that we had with our private money lenders is deferred payments. Not all private monies are okay with that, though. Private money lenders are okay with that. We were able to negotiate that, but again, we had a strong track record. As you get a track record, that's something that you may be able to negotiate. Or if not deferred for the entirety, where it just accrues the entire loan term, maybe deferred for a couple months until you get the project moving along. And then cash at closing. Like, you're not going to get this from really anyone. Some hard money companies may allow you to take your first repair draw up front. Because if you remember, I said that repair draw, even though they'll give you 100% financing, they will hold back the repair draw and they'll reimburse you once you submit invoices later on. So they want to make sure that the repairs are done first, and then they'll reimburse you for that expense up to whatever your repair draw is. With private money lenders, you may be able to get that up front. Now, this requires some responsibility. Some like savvy private money lenders, they're going to be like a hard money lender. They'll be like, no, I want you to submit receipts and I want you to do the work first, and I'll reimburse you for that. That's smart. It makes sense. You might be able to negotiate getting that first draw up front at closing. And that's really going to help you keep from having too much cash out. But regardless of the case, private money lenders are a lot more flexible and negotiable on how those terms are. And that's going to ultimately allow you to do more deals. Now, private money is attracted to two things: good deals and trustworthy investors. It's all about the relationship, backed by great deals. If you've got a strong relationship and you have good deals, this can be just a very, very valuable relationship for both of you, where you can make a lot of money. Now, the question though is, how do you find private money? How do you find private money lenders? Well, if you remember in the deal flow section, I mentioned that you must always be marketing for two things. You got to be marketing for deals, but you also have to be marketing for dollars. And then I broke down the 4 questions that you need to ask yourself in order to find good deals that fit your business model, the ideal deals that you're looking for. So it shouldn't be surprised. You shouldn't be surprised when I say those same 4 questions you want to ask also whenever you're looking for dollars, when you're marketing for dollars. First question is, what kind of lender? Well, we've already kind of asked that, right? We're looking for private money lenders. Second question is, where are they? They're everywhere. They're hiding in plain sight. Every single person that walks down the street is a potential private money lender. Now, it's also true that not everybody walking down the street has money to lend. So they may be a potential private money lender, but if they don't have any money, then they kind of like nix that. So really, you have to ask yourself the next thing: who has them? And that really means, who has the network or the market of people that actually have the money who could be a private money lender? First is you. Like, it starts with your warm market, your friends, your family, maybe coworkers. Now, if you don't have a rich uncle or a doctor friend or whatever, you're not in a very lucrative or high paying industry, that's okay. Most people, probably your situation. Ask for referrals, because if you don't have anyone that a rich uncle or doctor friend or whatever in your close warm market, your warm market probably does. So when you expand out and ask for referrals, like, it's okay to ask for referrals. Let people know what you do and ask them if they know anyone that might be interested in partnering with you via a private money loan on a deal. You'd be surprised on what you might find. Now, really? Be honest. I mean, do this, but understand that it's very unlikely getting started that you're going to have your rich uncle, Dr. Friend, or some referral that doesn't know you very well, just open their wallet and give money to you. So you want to do that, but also go to networking events. Go to specifically real estate networking events, because those are people who are already predisposed to real estate. But I mean, you could really go to any networking event. I mean, any networking event with, people, with where people with money might hang out. Self-directed IRA custodians. It's really one of my favorites because, they are selling a product, and like an IRA account, and they're marketing towards people who have money who want to invest, and they're educating their target audience, and they're hosting typically virtual or in-person events. So these are people, they're actually targeting people who have money, who want to invest. You should probably attend those events too, right? And when you gain some experience and you get to know the custodian, they may even ask you to speak at their event. So how many private money lenders do you think you could meet, connect with, talk to, if you were actually on stage at one of their events? Probably a couple, right? And then it was talking about networking events, and it doesn't have to be real estate specifically. Other types of networking events could be private clubs. And these are your country clubs, business clubs, exotic car clubs. Like if you're like a Lambo or Ferrari enthusiast, go to those. Flying clubs, executive sports teams, like the club area for the football or basketball games or whatever. Go to those because people with money go to those. And if you're generally interested in those type of those hobbies or interests, then you have a connection with them. So find a way that you can actually go to those and talk, hang out. As long as you're hanging out with people who have money, talk to them, get to know them. And who knows, maybe one of them might fund your next deal, or if not, refer you to someone who could fund your next deal. So networking is really the single best way to find private money. Like, sure, you could use like direct mail, pay-per-click, cold calling, and other types of marketing to find private money or private money lenders. You could do that, but I mean, you got to think about it. You're talking about people who you don't know yet, you don't have a relationship with, and you're trying to get them to hand you their hard-earned money. So unless you have a highly visible and reputable brand, it's very unlikely that you're going to get them to open up their wallet without a relationship first. So it just makes it so much easier to start and put yourself in the position to build that relationship by actually showing up in person and going to networking events and getting to know them. So knowing this and knowing where people with money might hang out, you know what you need to do. You got to network. Now, I want to make a recommendation of what not to do. I know I said you could potentially, do some direct marketing towards, for private money, but I don't recommend it. Not only is it going to be, unless you just have this big brand, a very reputable brand, it's going to be very challenging to do that. But also there are some other problems. So I'm talking about public advertising, social media, even like the free stuff, like the social media, putting out content, or even private money lenders that live outside your state. And it really comes down to securities laws. You have to beware of securities laws and understand the exemptions. Now, you want to do this anyway. So this isn't just a warning or a heads up on if you're going to advertise. Like, remember, because I even threw in free content. Like, you really need to understand this stuff. Go through and read it, because there are fine lines that you cannot cross. But there's also some gray areas that it's up for legal interpretation. And when you're in doubt, you really need to ask a securities attorney, an SEC attorney. Let them know, hey, this is what you're doing. This is what you're promoting, like whatever your marketing material is. And by marketing material, I'm talking about a Facebook post. That could be considered a marketing material. So just let them know, hey, this is what I'm posting. Is this okay? Is this email okay? So if you're in doubt, you need to ask an SEC attorney, because the federal security laws they're very complex. The penalties are severe, and they don't care if you're a real estate tycoon or if you're a new investor that just got started. They just don't care. And there's both state and federal laws that you have to be cautious about. Now, I say all that, but I also want to say, I personally, from my experience, from what I know, have no concerns educating my audience on what a private money loan is. I don't have any concerns educating my audience on how a private money loan works, on case studies of prior deals that I've done with private money loans, with general terms. We're talking about here, I'm talking about general terms, the 8 to 12% or whatever. I don't have a problem talking about generalizations on what a private money loan terms could look like. I'm just cautioning you that you can't promise or even hint on a promise of a certain guaranteed rate of return. You just can't do that. Also, you can't group investors together, multiple private money lenders that are all going to go in on the same deal. Advertising equity opportunities or offering compensation to anyone who's going to refer a private money lender to you or an investor to you. And when I say you can't, really what I'm saying is you can't unless you know what you're doing, then you need to go back to the SEC attorney. Now, circling back, I have no concerns educating my audience. So if you're going to promote on, in the free channels, Facebook posts, TikTok, email, or whatever on your website, you might want to check with an SEC attorney. This is not legal advice. I'm just saying I personally have no concerns educating my audience without giving any type of promise or even hint of a promise of some future return that they may receive, unless I've given clear guidance from an SEC attorney that what I'm doing has been approved. So just wanted to get that out there. It's not necessarily like you should be a little scared enough to do your homework and to get educated, but as long as you're educating, should be okay. But again, when in doubt, check with an SEC attorney. But either way, you do want to get educated. You want to get educated on the law. You also want to get educated on how private money lending works, and especially what it looks like from the lender's standpoint. So a few recommendations I have are Brant Phillips. He wrote the Private Lender Playbook. It's a phenomenal book that's designed for the private money lender. Like, this is a book to educate private money lenders. Don't you think if you understood, more what a private money lender would look for in a deal, that you could then position yourself and your opportunity to give them what they're looking for up front and know what questions they may have in advance, know the answers to those questions. The Hands-Off Investor by Brian Burke. Another phenomenal book. Now, this one's more in syndications, multifamily syndications, or if you're investing in funds. Phenomenal book. Even if you're not like looking to raise money from a syndication or whatever, you can still get a lot of value out of that, because it's still ultimately the communication and how to be organized as an operator, as someone running a business looking for financial partners. That can be still a great book. But if you're in the multifamily or syndication or fund space, like, that book is phenomenal. And then Top Tips After 100 Flips. We also have some nuggets in there that you can take advantage of or take note of. And these books you can find on our website. If you go to investedagents.com/books, you can find each one of these. Great books. They actually, Brian Burke and Brant Phillips both have spoken at Real Estate WealthCon last year. So we've got some for our community. If you want to go back and check their presentations, they're available to you. So should you work with just anyone? Like, anyone with money that wants to loan you money on a deal? Should you work with just anyone? My advice is no, not anyone. Because remember how I said with partnerships and JVs, it's like a temporary marriage. A private money lender, kind of the same thing. They may not be a direct partner unless they have some equity stake. If it's just a loan, they're not necessarily a partner, but it still is a relationship on that deal. So it's still somewhat of a partnership, even though it's not like a formal, what you would consider a partnership, as far as they don't have equity. So with that in mind, you have to use your judgment. There's some people you just may not want to work with. Maybe it's a personality thing. But for most people, it's really going to come down to, are they even interested in real estate? If someone is very scared about real estate, then real estate, loaning on your real estate deal may not be the best thing for them. And you don't want someone calling you every single day, very worried about their investment, how things going, and just kind of beating up your phone because they're just so nervous about it. Like they just don't understand it. Probably not the best fit for you. Doesn't mean you can't build a relationship. Maybe at some point in time they can become comfortable with it. But if they're not comfortable with investing in real estate to begin with, may not make they may not make a good private money lender for you. Allows you to maintain control. You do not want someone who's going to take control of your company or try to undermine things that you're going to do for their best interests, because their interests are a little bit different than yours. Even though there's a lot of overlap, you really want to make sure that you're maintaining control over the deal and your company. Folks that look for low risk, and by low risk, real estate has risk, but it's mitigated by equity because you're getting deals at a discount. Your expertise should be also another way that you have low risk, where there's personal guarantees involved and your team in place, your contractors and whatnot. So you want investors that are looking for low risk. And also this is a hard asset that has tangible value and can be very easily determined by pulling comps and working with agents or appraisals. And then investors that want a reasonable return. So there are so many investors that are just scared or tired of the ups and downs of the stock market. And this is where real estate can, especially private money lending, can be a very viable solution for them because they like the dependability of knowing that they're going to get a set percentage on whatever their loan is. They're going to get that every single month or whatever the terms are that you negotiate. These types of folks tend to make great private money lenders. Now, here's a conversation that if you really listen to the nuggets here, this is going to change your business forever. So I see a lot of newer investors, not even just newer investors, just investors in general. They'll go to networking events, and when they're talking with prospective, private money lenders, the moment they get in that conversation, they start pitching them on a deal. And that's like the worst thing you could do because it's like kissing on the first date, but before dinner. Like, sure, you could do that. Maybe it would go well, but most likely you're just going to end up scaring them off because it makes you come off desperate. No lender wants to work with someone who's desperate. Banks don't want it, and individual private money lenders definitely don't want it either. So instead, talk to them, start building the relationship. Ask them what their experience in real estate is. What is their experience? What kind of deals have they done before? What kind of deals are they even interested in? What markets are they interested in? What kind of rates of return do they look for? What terms do they like to see? How many loans have they done? What are their goals? Like ultimately, what are their goals? Why are they even lending or interested in lending in the first place? Get to know them. Build the relationship before you go in for the kiss. And then once you've gotten to know them and their goals, you can give them the 30 to 60 seconds, kind of high level summary about your business and what you do. And it's okay. Like if they have more questions, it's okay to talk more and answer questions, but you do want to leave them wanting more. And say this. This is the big phrase that I've used, and it's worked very well in building strong relationships with potential private money lenders right now. So we'll be talking, getting to know them. They may ask me a couple of questions, and then we'll kind of leave it like, well, it's nice talking with you. I don't have any deals that right now that don't already have funding, but I can reach out to you when the next deal comes through and just kind of get your opinion on it. See if it's something you might be interested in. And I can even send you a little information on our company in the meantime. How would you like that? Just something that simple. Because when you do that, their guard's not up because you're not asking them for money. You've already told them you don't need any money. Guard's down, and you're putting them in a position to lean in. 9.9 times out of 10, like I don't think it's probably 10 out of 10. I don't think there's anyone who said, no, don't contact me. They always lean in at that point. And it gives, and this is a time where you're going to exchange contact information. And what they've done there is they've given you an excuse to contact them again in the future. but you also said, hey, I can send you a little information on my company. So what I would end up doing is I had a 1 or 2 pager. It was just kind of a high level overview on what we were doing, prior deals that we've done, some before and afters, some details. And I would send that over to them. Hey, I would send, later on, like the next day, hey, it was nice to meet you. Here's here's an executive summary on our business and what we do. Look forward to connecting with you again whenever our next deal comes through. Feel free to reach out anytime. Send that over, and then just stay stay in touch with them. So this is the best way, in my opinion, to start building that relationship. Don't come off as needy first. Have them lean in, get their contact information, continue building that relationship. And then when that deal does come along, do not expect that they will actually loan on it. Most likely they will not, because they're still getting to know you. And we'll send that over. Maybe they say no, which probably they will. Hey, great, totally understand. How would you like it if I keep you updated on how this deal goes? And then when that deal is done, hey, just want to let you know, hey, that deal, we did this. Here's some before and after pictures. Got it on the market, or hey, we already sold it. We did this, pretty good. How would you like me to reach out to you on the next one? You do this a couple times, then if they're sincerely interested in private money lending, they're going to start warming up to the yes. That's when you can lean in for the kiss. So what are your private money lending rules? You probably want to set some for yourself, and they're definitely worth considering, because just like you don't want to partner with every private money lender. There's also certain types of private money lenders, like just the terms may not even match what you're looking for. Loan minimums, like what's the smallest number, amount of loan that you could even consider? And this is really probably going to be more just the actual properties that you're buying, because if a private money lender, if they only have 20,000 and you're buying properties in the $150,000 to $200,000 purchase price range, it's going to be hard. It's going to be kind of difficult to work with them. But figure out some loan minimums. Are they doing accrued payment, monthly payments or accrued payments? I always negotiated accrued, but there were some private money lenders that they required monthly payments, and I typically would discount them, meaning I would go with my lenders that would allow me to do accrued payments. But if I needed to, I would definitely use them. I'm not against making monthly payments. I just want to avoid it if I can to preserve cash flow. And then one lender per lien. I never, ever, ever would group multiple private money lenders together on a single first lien loan. That could be considered pulling money, could be an SEC issue, could be a concern. I didn't want anything to do with that. Now, if you've got a private money lender where they've, them and some buddies want to get together and collectively loan to you on a deal, I would have them reach out to their attorney and draft all that stuff. I'm not going to be the quarterback of that. You don't want to have anything to do with that. Personally, it's just so much easier and cleaner if you have one lender per lien. And then loan to value ratio. Like, what is the minimum loan to value ratio that you want? A lot of hard money companies will give, loan up to 100%. Not in all markets. I know in Texas you can get 100% from pretty much any hard money lender, but in other markets, I'm aware that some hard money lenders still want you to put 5 or 10% down. Really, private money lenders should be one-upping them. They should be a little bit more flexible on what those terms are. With every deal I did, it was always 100%. Like, it was no money was coming out of my pocket at closing. That was a hard and fast rule. If they wanted me to put 10% down or 5% down, it was not going to work. And if they were able to find borrowers that would go with those rules, great for them. Just for me, I wasn't doing it. Now, we had the experience and the track record to hold firm on that. Early on, you may not have that. So, which is why you probably should get a few deals using hard money lenders. But as you get more experience, this is something that it shouldn't be difficult to negotiate. And then equity participation. Personally, with 200 something flips, there's only a couple deals that we did that had equity participation. Didn't do a lot of them just because really equity participation, that's your most expensive way to finance deals. And you're typically doing that. This is like your JV. It's almost like it's like a JV deal where a lender, maybe they're giving you a favorable terms on a loan, Or maybe they're coming in and they're using all their cash or financial resources to come in with a deal. And then you're splitting the deal 50-50, 74-30, or whatever. So if that is something you would consider, what would you consider? Like, what would those terms look like? I always had financial resources available. So there's very rarely did I did that when I was house flipping. I do it a lot more now, but it's in a different realm, especially with multifamily and other projects. But it's still something you want to consider. And then disclose the risks. You have to disclose the risks. I included this in my like 1 or 2 pager that we would provide. Remember when I was talking about how I would send them, after I connect with them, I'd send them a quick summary on our company. Disclose the risks. Let them know what the risks are. There are risks in real estate. Let them know the risks, and then let them know how you've mitigated those risks, the steps that you're taking to make sure that those risks are minimized as much as they possibly can be. They already know, like most likely, they already know what at least the couple general risks that are are out there with real estate. It's going to sound a lot better coming from you when you're telling them that you know the risks too, and you've taken some steps to help make sure that those risks are mitigated. Here's just a couple more slides, and then we're going to wrap this one up. The process of a hard money loan, or really any loan, it's pretty much the same. You're going to go out, you're going to find a deal, you're going to get that deal into contract, and then you're going to go with your lender and establish the terms. Then you go to closing. Then you actually execute on the deal. You flip the house, you rehab it, rent it out, and then refinance or whatever. Then you rinse and repeat. From a private money lender side, this is kind of how it breaks down. You got the borrower, you go out and find a deal, and you open title, but you talk with your private money lender. You discuss the deal. They're interested. You figure out what those terms are, and you both agree on. Then you go to an attorney. Go to an attorney, have the attorney prepare documents. That is sent over to closing or title. You go to closing, everything's signed, all money's handled at closing. That's when you go out and you start executing on the project. You're doing your renovations. If there's any monthly payments, you'll make those all the way until the point to where you either sell or you refinance, and you just keep repeating this process. Now, the key to success is by focusing on helping and serving others and creating true win-win partnerships. If you do that, the rest will come easy. This is both on working with motivated sellers, helping and serving others, win-win, and also with your private money lenders. Now, whatever financing option you choose, you want to close at a title company or an attorney with attorney states. Use an attorney to draw up loan docs. Don't download these off the internet and just haphazardly fill them out yourself. Don't do that. Have an attorney draw up the docs. Experienced private money lenders, they probably already have one. You can go to the title company. They have referrals on private money lenders or referrals on attorneys that can draw up docs. Whatever attorney you're using, make sure they understand real estate and make sure you use one. Get title insurance. Include the lender's title policy. Get a survey. This is just good practice anyway. Get a survey. You want to know what the boundaries, easements, and encroachments and all that stuff are. Maintain proper insurance. Kind of a no-brainer there. Every lender will require it. Just kind of good practice. And any funds that you receive, you want to make sure you're receiving those through closing. Now, after closing, there'll be some repair draws that's post-closing. But as far as on the acquisition side, that all needs to go through closing. You don't need to take any side checks. Never let a lack of money stop you from doing a deal. It's kind of the summary here. Financing is not an excuse to not do deals. There's too many ways to finance deals. It's a mindset. And once you have that really ingrained in your head that there's an abundance of cash out there for good deals, you just need to go find good deals. And then you can find the partners, the financial partners, whether hard money lenders or sellers financing or private money lenders, to help you close on those good deals. So that wraps up the financing part of this masterclass. Next up is rehabbing. We're going to be talking about how to manage rehab projects, manage contractors, and ultimately make sure that your project is finished on time, on budget, and with high quality. So look forward to seeing you then.